Hey guys, it's your boy Jay Kabata back here with another video. In today's video, I'm going to be giving you guys 3 ETFs that are going to make you rich. I'm not joking. Over time, these 3 ETFs will make you rich. So as many of you guys know, the stock market gives us an average return of 10% a year. That means that if you're just investing in the stock market, you're going to get back your money plus 10%. I want to start off this video by saying that if you're not investing, then by the end of this video, you should at least be investing in these 3 ETFs. Of course, as I always say, I am not a financial advisor, so you should always do your research before you invest in these 3 ETFs. But with the research that I have done, you will definitely be able to see that with these 3 ETFs, you can definitely have a great potential to make a lot of money. Plus, who wouldn't want to make money instead of just leaving their money in the bank and making nothing? If you're enjoying my content, make sure to sub to the channel and give this video a like. I appreciate all the support you guys have given me. Also check out my Patreon. Link's going to be down below in the description. I buy stocks every single week on that Patreon. And you will be able to see exactly how much I'm investing every single week. I actually just sold all of my dividend stocks and I reinvested that into growth stocks. So if you'd like to know a little bit more about that, just make sure to click that link down below for my Patreon. So before we get started with the ETFs that I'm going to recommend, the first thing that you guys need to know is what is an ETF. I'm going to make this super simple for you. ETF stands for Exchange Traded Funds. Basically an ETF, all that really means is that it's a lot of stocks in one. So just think of a basket of stocks. Here's one example of that. So let's say you want to invest $100 in an ETF that has around 200 stocks. So when you invest that $100 in that ETF, those $100 are going to be split between those 200 companies. Now the reason people do that is because that is a lot safer than just putting $100 in just one stock. If that $100 is split up into 200 different stocks, then that would in general make it safer, because if one of those goes down, maybe the other 199 are going up. First ETF that I'm going to give on this list is going to be VTI, Vanguard Total Stock Market ETF. They're currently trading for $225 and they went up 117% in the last 5 years. VTI has over 3,700 stocks. What that means is that anytime you put money into it, that money is being diversified into 3,700 stocks. So 5 of VTI's biggest holdings are going to be Microsoft at 4.33%, Apple at 4.33%, Amazon at 3.17%, Facebook at 1.82%, and Google at 1.63%. An expense ratio is just basically what the company that owns the ETF charges you for them managing all the portfolio. So yes, investing in an ETF will cost you because you're investing in it and the company is picking all the stocks and changing them out for you. But don't let that scare you, because the expense is just really low and the amount of money that you can make is definitely going to outperform that. The expense ratio for VTI is 0.03%. What that means is that if you invested $50,000 within that year, you're only paying $15 in fees. That is just a super low amount for how much money you could have made. So just showing you guys a quick example of this, VTI went up 40% in the last year. If you invested $50,000, you would have made around $14,000. I just need you to understand that point, because many people get scared that, oh, they have an expense ratio. Oh, this ETF is going to charge me. I should do it on my own. Yes, they do charge you, but the price is very minimal. Of course, other ETFs do have different expense ratios, but VTI's is a very minimal one. The next ETF on the list is going to be VUG, Vanguard Growth ETF. They're currently trading for $290 and they went up 181% in the last 5 years. So VUG went up approximately 63% over VTI. And what VUG is that it's basically a growth ETF and they focus more on companies that are focused on growing their company. So just so you know, a growth company, what they usually do is they don't really give you back dividends. They reinvest in themselves because they're trying to make the company become better and grow bigger. Growth companies usually have a higher return compared to dividend companies. VUG has approximately 280 stocks within the ETF. And their biggest holdings are Microsoft at 9.9%, Apple at 9.39%, Amazon at 6.88%, Facebook at 3.95%, and Google at 3.54%. The expense ratio for VUG is 0.04%. What that means is that if you invested the same $50,000 that you invested in VTI, you're only paying $20. So that's only $5 more. And just think about the major growth that you had with choosing VUG over VTI. You literally made over 60% more for only paying $5 more in fees. As many of you know, if you guys follow my social media or if you guys follow my Patreon, I actually sold all my dividend stocks and I am focused on growth. And as you just found out, VUG is definitely a growth ETF, so that is definitely an ETF that I do like. And the last ETF that I'm going to give you guys today, and this is absolutely my favorite ETF. I need you guys to buy this one. Just please, whatever you do, if there's anything you buy, it's going to be this one. Just remember, I'm not a financial advisor, and just do your research. I absolutely love this one because it just definitely has the most potential to grow. That ETF is going to be QQQ. QQQ is basically the 100 largest non-financial companies. QQQ is currently trading for $358, and they went up 246% in the last 5 years. That is a 65% increase over VUG in the last 5 years. So although I love VUG, look at what QQQ did. It literally outperformed it by 65% in the last 5 years. QQQ's 5 biggest holdings are going to be Apple at 10.95%, Microsoft at 9.5%, Amazon at 8.32%, Tesla at 4.24%, and Facebook at 3.78%. Now QQQ does have the most expensive expense ratio out of the 3 ETFs that I mentioned on here at 0.20%, but I definitely think that QQQ outperformed the other 3. I'm going to show you guys a chart here shortly. So if you invested the same amount of money, those $50,000, you would only pay around $100. Now yes, that is $80 more than VUG, but if you just think about how much potential money you could have made during that time, then I definitely think that QQQ is the way to go here. I just want to show you guys this chart real quick. So QQQ is the blue line, VUG is the pink line, and VTI is the black line. And you could definitely see that QQQ outperformed the other 2 by a huge amount. Although I do love QQQ and it definitely outperformed the other ones, I think all 3 of these are definitely great, and they will definitely make you rich over time if you just invest in them. The most important thing is that if you're not investing in any of these, you need to choose one of them and you need to invest. Literally having your money in the bank and it not doing nothing for you is probably the worst thing that it could be doing. Make sure to sub to the channel if you haven't, and give this video a thumbs up. I appreciate all the support you guys have given me. It really means a lot. And check out my Patreon. Link's going to be down below in the description if you want to see what stocks I'm buying every single week. Let's keep growing that wealth together. Anyway, I mean it. I appreciate everything. Make sure you start investing if you're not. Until next time, guys.